Welcome to the Deep Dive. We crunch the earnings call so you don't have to. Today we're digging into Bank OZK, ticker OZK, and their Q3 2025 earnings call. And this one was a bit of a head-scratcher.
Oh, absolutely. You had management on the call, really hyping up these record results, record net income, record EPS, record net interest income, the works.
Sounded great on paper.
Yeah.
But then you look at the stock reaction, a bit muted, maybe even some selling pressure.
Exactly. So our mission today is to unpack that disconnect. Why the cautious market reaction when the headline screamed record-breaking?
Right. How do you hit all these records and still leave investors feeling, well, hesitant? Let's start with the numbers that caused the immediate friction. Operationally, things look solid, but the GAAP EPS figure landed at $1.59.
Yeah, and the street was looking for $1.66, so missed by 7 cents. That's about a 4.2% miss. And, in this market, any miss on that bottom line, especially EPS, it just gives people pause.
It really does. Even though, let's be fair, the top line showed strength. Revenue came in at what, almost $450 million?
$449 million. Yeah, beat consensus by a couple million, up 6.4% year over year. Solid.
And net income was strong, $180.5 million, plus that record net interest income, $413.9 million. You can't ignore that.
You can't. So there's the core conflict right there.
Yeah.
Strong operations, good revenue, record NII. But the EPS miss, it sort of shifted the focus away from this quarter's results and more towards, okay, what's the plan? What's the strategic timeline look like?
Okay, let's get into that. The strategic pivot. CEO George Gleason talked about the records, sure, but he seemed more focused on capital ratios improving and asset quality holding up.
Right. And the big strategic story here is the shift towards commercial and institutional banking, CIB. They're deliberately trying to grow that side of the business, maybe to 30-40% of the loan book over, several years, diversifying away from their bread and butter, the Real Estate Specialties Group, RESG.
RESG is what they're known for, those high-yield construction loans. Why pivot to CIB? Is it just diversification for risk's sake?
Well, risk is part of it, but it's also about efficiency, ROE efficiency. CIB offers more opportunities for fee income, treasury management services, and crucially, access to cheaper deposits. Think non-interest-bearing accounts.
Oh, okay. So lower cost funding base.
Exactly. Compared to the RESG loans, CIB relationships, while maybe lower yield on the loan itself, can be more profitable overall for the bank on an ROE basis because of those fees and cheaper deposits. It optimizes their capital better.
So it's a smarter use of their balance sheet long term. And we saw signs they're already executing this.
Yeah.
Like shrinking the fund finance book.
Yeah, they're actively managing that CIB portfolio, getting out of legacy relationships that maybe had big unfunded commitments tying up capital but weren't being drawn on much, optimizing utilization. CIB originations were actually strong this quarter, but the net growth number looked a bit muted.
Why is that?
Because some of their CIB clients were tapping the high-yield bond market, which is hot right now, and using the proceeds to pay down their OZK loans faster than expected. It's a sign of healthy clients, but it does dampen that net loan growth figure for now.
Okay, that makes sense. But this leads us to the big shadow looming over the short term. The 2026 headwind. This seems to be where the market caution is really coming from.
It absolutely is. Management was pretty upfront about it. Remember 2022? OZK had a monster year for RESG origination.
$13.8 billion, right? Record level.
Exactly. And those RESG loans typically have a, say, 3 to 4 year lifespan. So do the math. 2022 plus 3 or 4 years. We're getting right into the peak maturity wave for that huge vintage.
The payoff wall.
That's the term. Management themselves said they expect an exceptionally high level of paydowns all through 2026. It's just the natural cycle of that massive book rolling off.
So they're basically going to be running hard just to stand still next year, trying to originate enough new loans, CIB or otherwise, to offset this huge RESG runoff.
That's pretty much the picture they painted. They are still aiming for record NII and EPS again in 2026, which is, encouraging. But the growth year over year, they guided to small or modest, think mid-single-digit loan growth overall. So 2026 looks like a year of consolidation, absorbing that wave.
Okay, so if you're an investor, you're not really banking on big growth next year. You're looking past that.
You have to be. The real story, the catalyst they're pointing to, is 2027 and beyond. That's when they expect material EPS growth to kick back in. The RESG payoff wave should have crested by then, and the newer CIB and maybe the indirect Mariner of e-businesses will hopefully be firing on all cylinders.
So it's a wait-for-it story. Patience is required.
Very much so. 2 years is a long time in the market.
All right, let's shift gears slightly. Away from the long-term strategy and back to the present-day concerns. Credit quality and interest rate management. How did asset quality actually look this quarter, especially with all the CRE jitters out there?
It was kind of a mixed bag, honestly, and they didn't shy away from that. On the negative side, they did report 3 credit migrations. 2 of those moved to substandard non-accrual.
Which means charge-offs.
Yep, associated charge-offs came with those, so not ideal. That always catches the eye.
But there were some positives offsetting that, weren't there? On the workout front.
Big time. The major win was selling their largest foreclosed asset, that Lincoln Yards land parcel up in Chicago, and they sold it at book value. Getting rid of a large OREO asset without taking a further loss is a significant positive.
Definitely. Any other movement on problem assets?
Yeah. They also mentioned their second and third largest OREO assets are now under contract to be sold, expected to close this quarter, Q4, and they anticipate the outcomes will be neutral to maybe even slightly positive financially. So good progress cleaning up legacy issues.
Okay, that's reassuring. And what about the core defense mechanism for their RESG book? Sponsor support. How's that holding up? Are developers still standing behind these projects?
That seems to be a real strength, and the metrics they shared were pretty compelling. They had 41 loans get extended during the quarter, shows sponsors are willing to work with the bank. Sponsors also posted nearly $70 million in additional reserve deposits.
Wow. Okay. Putting more skin in the game?
Exactly. And the bank collected about $13.5 million in related fees for these modifications and extensions. Management made a point of saying these numbers, the extensions, the added reserves, the fees were among the highest they've ever tracked. It suggests their high-quality sponsor base is stepping up, recapitalizing projects, and seeing them through this tougher rate environment.
That's probably the single most important data point for calming CRE fears around OZK specifically. The sponsors aren't walking away. Okay, let's talk rates. Net interest margin, the NIM, they use a lot of 7-month CDs for funding. What does that structure mean when or if the Fed starts cutting rates?
Yeah, that 7-month CD is their dominant product, like 80% of their CD issuance. It means their deposit costs are sticky on the way down. Think about it, if the Fed cuts tomorrow, the bank is still paying that higher CD rate for up to 7 months. So their funding costs will lag any drop in loan yields by, say, roughly 2 quarters.
Which squeezes the NIM temporarily. Loan yields fall faster than deposit costs.
Exactly. You get this temporary compression. It's predictable, but it happens.
But they have a hedge against that on the asset side, right? The loan floors.
They do, and it's a crucial cushion. At the end of Q3, about 22% of their variable rate loans were already at their contractual floor rate, meaning the interest rate on those loans literally can't go any lower unless the index drops below the floor level, which is unlikely in the near term.
So rate cuts won't immediately lower the yield on almost a quarter of their variable book.
Correct. And they added that if the Fed cuts just another 25 basis points, that percentage jumps to 36%. 36% of the variable book hits its floor. So these floors significantly slow down the drop in overall loan yields, which helps shorten that period of NIM compression when rates do fall. It cushions the blow.
Okay, that makes sense. It limits the downside on NIM when rates eventually turn. One last check on credit hygiene. Circling back to the new CIB book, you mentioned it includes some areas generally seen as higher risk, like non-depository financial institutions, NDFIs. How are they making sure they don't swap RESG risk for a different kind of risk there?
That's a key question, and they stressed a very conservative underwriting approach. For NDFIs specifically, they tend to focus on deals where they are the only lender, or maybe it's just a 2-bank club deal, gives them more control than being a small piece of a huge syndicated loan.
More direct oversight.
Right. And they use this term bottoms-up risking.
Okay, translate the jargon for us. What does bottoms-up risking actually mean?
It basically means they're not just looking at the NDFI company itself, the parent lender. They're digging deep into the underlying loans or assets that the NDFI holds on its own books, assessing the credit quality of the NDFI's portfolio. It's much more granular due diligence than just underwriting the NDFI's balance sheet.
So really understanding the ultimate source of repayment.
Precisely. And they put a number on their selectivity. The CIB team said their current pull-through rate, the percentage of deals they look at that they actually close, is less than 15%.
Wow. So they're saying no to 85% of the CIB opportunities they review.
That's what they claim. It signals extreme caution as they build out this book. They're prioritizing quality over just hitting volume targets.
Which is good for credit quality, but it does bring us back to that 2026 problem, doesn't it?
Yeah.
If they're that selective in CIB, can they realistically originate enough high-quality volume to offset that massive RESG runoff and drive the growth needed for 2027?
That's the multi-billion-dollar question, isn't it? The execution risk on this pivot feels quite high. But remember, the CIB strategy isn't just about matching RESG volume dollar for dollar. It's about generating better returns on capital through those fees and cheaper deposits. It's meant to be a quality over quantity shift. But you're right, hitting those fee and deposit targets is absolutely critical for it to work.
Okay, given this whole setup, the known slowdown in 26, the hope for acceleration in 27, let's move to our hypothetical trade segment. How might someone purely theoretically try to play this?
Well, this timing dynamic, the known 26 turbulence versus the 27 potential, sets up nicely for a volatility and time-based option strategy. The market clearly sees the 2026 payoff wall coming, so you'd expect near-term implied volatility to be somewhat elevated, or at least for the stock to be choppy.
While the 2027 growth story might be discounted because it's still a ways off.
Exactly. So one hypothetical idea could be structured around capturing that difference, maybe something like selling some near-term volatility. For instance, you could consider writing shorter dated options, maybe puts or calls expiring late 2025 or early 2026, collect the premium while the stock potentially churns through that payoff period.
Use the market's short-term anxiety to generate income.
Right. And then use that premium collected or add capital to fund the longer-term bullish bet. You'd simultaneously buy longer-dated call options, say January 2027 expiration, maybe struck a bit out of the money.
So you're betting that by early 2027, the payoff wall is in the rearview mirror, CIB is contributing meaningfully, and the market rewards the bank with a higher multiple for that growth and diversification.
Precisely. You're monetizing the known near-term headwind while positioning for the potential long-term strategic success and that material EPS growth they're forecasting for 2027. It's a pure play on management executing that timeline.
Okay, interesting idea. Let's recap the key takeaways from this Bank OZK deep dive. Q3 showed continued operational strength, record NII, but that EPS misfocused everyone on the strategic timeline.
Yeah, the narrative is firmly set now. 2026 is about stability, managing the huge RESG runoff with modest overall growth. Think mid-single digits. 2027 is positioned as the year for significant acceleration, driven by the CIB pivot gaining traction and the payoff headwinds fading.
We talked a lot about the risks, the RESG payoffs, potential credit issues, NIM pressure, but maybe let's leave our listeners with a different angle to consider.
Okay, here's a thought. Everyone focuses on the commercial real estate risks in the RESG book. Understandable. But what if the real execution risk isn't about legacy asset quality, but about whether management can actually deliver on the promise of the CIB pivot? Can they successfully generate the targeted fee income? Can they attract those low-cost core deposits? Can they do all that efficiently enough to maintain OZK's historically stellar return on equity while the high-yielding RESG book naturally shrinks as a percentage of the total?
That's the core challenge, isn't it? Shifting the engine without losing altitude. Executing that CIB strategy profitably is everything.
It really is. That's the metric that will likely define the stock's performance over the next few years, perhaps even more than the CRE headlines.
A great point to ponder. And just a reminder to everyone listening, that trade idea was purely hypothetical for discussion purposes.
Absolutely. Not financial advice. Always do your own research and consult with a professional advisor before making any investment decisions.
Thanks for joining us for this deep dive into OZK's quarter.
Always a pleasure. We'll catch you on the next one.
See you next time.